Okay, well, good afternoon. Welcome and thank you all for coming. I am Brian O'Connor. I'm the co-head of the tax group here at Venable, and I'm going to be everyone's moderator today for our presentation on opportunity zones. I've got a very distinguished group here with me up on the panel. To my left, I've got Walter Calvert, who is, I'll call him a senior partner because he's older than I am. Senior partner in our tax group. To his left, I've got Liz Steep, who's a senior associate in our Baltimore office in the tax group. To her left, I've got Doug Truehart, who's a principal at the accounting firm of E. Cohen and Company. And last but not least, I've got Chris Feist. Chris is the founder of the Oasis Fund, and he's going to be our man on the ground here today. With that, I'm going to turn it right over to Doug to get us started.
Hopefully I can work these, not the top button, not the middle button.
There you go.
Okay. What we're talking about today, our Qualified Opportunity, the Qualified Opportunity Zone Program, which for those who are interested in code sections, covered under code section 1400Z-1 and 1400Z-2. And what it does is the program provides incentives for long-term private sector investments in low-income communities. Section 1400Z-1 goes through how the opportunity zones themselves are going to be defined and determined, and there are, which have already happened, and there are 8,761 tracts that have been designated as qualified opportunity zones. Included in all 50 states, the District of Columbia, and 5 U.S. territories. In your slides, there's actually some references a little bit further on that you to websites where you can actually find what has been designated as a QOZ. Internal Revenue Code 1400Z-2, and these will be hopefully my last reference to code sections, provides incentives provides investors with various incentives to invest in the qualified opportunity zones. And what an investor is investing is what is known as eligible gain, which I will get into. And you make an election to invest this eligible gain on Form 8949, which is filed as part of your tax return. The incentives, keeping in mind that we're talking about investing gain, 3 major tax incentives. First of all, the recognition of that gain is deferred for a period of time. There is a partial exclusion of part of that gain, taxation on part of that gain, your original gain on the original investment. And then going further, there's an exclusion of the appreciation of the gain in the qualified opportunity zone itself. And I go through these incentives one by one, but let's first look at what constitutes eligible gain. What we're really talking about is for an investor who has a gain, a capital gain, or a gain on an investment that is treated for tax purposes as capital gain, they can take that gain, the dollar amount of the gain, and invest it in a qualified opportunity fund. Qualifications, it's got to be treated as capital gain for federal income tax purposes, would be recognized for federal income tax purposes otherwise by January 1st, 2027, and the gain has to arise, does not arise from a sale to a related party. Note that the definition of a related party refers to 20% rule, which is a pretty low threshold in defining your related party. Gain, note that what we're talking about is gain treated as capital gain. Another reference to a code section, Section 1231 gains, which are gains from the sale of depreciable property used in a trade or business. Okay, if you have a net 1231 gain, that can also be an eligible gain for purposes of investing in a qualified opportunity fund. But keeping in mind that what we're talking about is net 1231 gains, and so if you have a 1231 gain in a taxable year and also a 1231 loss in the same taxable year, the two are netted together and your net eligible gain becomes the net of those. Keeping in mind also that on the sale of depreciable property used in a trade or business, what we're talking about, gain to the extent that it exceeds prior depreciation that you have taken on that equipment, that property. That, to the extent of prior depreciation, that's treated as ordinary income and is not eligible gain for purposes of qualified opportunity fund investment purposes. So what taxpayers are eligible taxpayers for purposes of this incentive? Basically, any taxpayer. It can include C corporations, it can include individuals, partnerships, S corporations, trusts, and estates. Now, with respect to partnerships and S corporations, which are flow-through entities, all right, the entity itself can elect to reinvest eligible gain, or they can flow it through to their individual owners, and the individual owners can then on their own decide whether or not they want to reinvest in a qualified opportunity fund. Okay. Note that what we are talking about is only the gain itself, the eligible gain. If I have a sale where the sales proceeds are, say, $10 million, and I have a basis of $5 million, I've got a $5 million gain. The only investment that I can make that would qualify for the incentives that I'm going to talk about a little bit more in a second is the $5 million gain. Okay, you can invest the entire $10 million, but only $5 million of it would qualify for the incentives associated with qualified opportunity zones. You don't have to, going back to my example, I've got a $5 million gain. I don't have to reinvest the full $5 million. I can invest any part of that $5 million. I can also invest that $5 million in multiple qualified opportunity funds, and there are no tracing rules, which means that to the extent that I receive that $5 million, I don't have to keep it in a separate account and then reinvest it in a qualified opportunity fund. It's just the dollar amount is what has to be invested. So there's no tracing rules with respect to the specific funds from the gain. Let's talk about the timing of the investment. The general rule is that your eligible gain needs to be reinvested within 180 days of the sale that gave rise to the gain. All right. What about gain that flows through from a partnership or an S corporation? As I said, in that case, the partnership or the S corporation can make the decision to reinvest the gain itself at the entity level, or they can pass it through and let the individual owners reinvest that gain. Well, in the case of the gain that flows through, you really don't know if it's going to flow through until the end of the taxable year, so you get 180 days after the close of that taxable year. The partnership or the S corporation, if they want to reinvest the funds themselves, they have to do it within 180 days of the actual sales transaction. So one of the issues that will come up is that if you have gain at a partnership level or gain at an S corp level, one of the decisions is, do I want that gain to flow through, or do I want to make the reinvestment at the entity level? We talked about net 1231 gain also being eligible gain. The issue with respect to that, keep in mind, we're talking about net 1231 gain. We don't know what that net 1231 gain is necessarily going to be until the last day of the taxable year, because I may have a gain in January, a loss in December, and it's the net of those two that get reinvested. And so for net 1231 gains, the 180-day period begins on the last day of the taxable year.
Doug, one hot topic I might add there, this is like fresh off the presses, I only heard this the end of last week, was there was concern that with partnerships, where you get an awful lot of 1231 gains happening in partnerships, people invest in, when the gain gets realized in the partnership, you got the same problem. You got to wait till year end to net the gains together, and then 183 days. The rules that the IRS has out now, in many instances, permit the partnership to be the investor that rolls gains into a fund. For this 1231 gain, they made no provision for that. It has to be the investor who does it after they get their whatever, Schedule K at the end of the year. They got to wait till then, and then their investment may have already come and gone that they wanted to invest in. By the time they get their K1, realize the partnership is telling them they have a net 1231 gain. The IRS informally at a meeting I was at last week, the guy said, well, we really hadn't thought about that. We will permit the partnership to do the 1231 investment of its own.
Right.
It can be the taxpayer. And again, the regulations I don't think read that way. He acknowledged that. But
right. And one of the issues that you have is, again, the timing. Say you have a sale in January, all right? The partnership, if the reinvestment's going to be at the partnership level, you've got 180 days from that point on. So you're talking about perhaps July. And at that point in time, there's still a lot of activity in that partnership. You're only partway through the year. But if the partnership decides that it wants to reinvest the gain, it's got to be 180 days from the date of the sale. With respect to the 1231, again, if the partnership is going to reinvest the 1231 gain, again, the 180-day period starts on the last day of the taxable year, because that's the first date that you're absolutely certain that you do not have net gains and losses to offset each other.
Now, Doug, though, there's a real positive side to this, in that we're talking about having all the way through June, for the most part, of the second year to make the investment to defer the gain that was realized in the first year. So there could be a sale in January of year one, and you're making the investment in June of year two to defer the gain from year one. I mean, that's a lot of time to find the right investment to make.
Now, one of the other keys that you've got to keep in mind is that there's got to be communication. I mean, you may be a passive investor in this partnership. Well, the gain that you as an individual can reinvest is the gain, capital gain that's flowing through on your K1 that you receive. Well, if the 180-day period starts on December 31st, you've got until June 30th to reinvest the funds. You may not have received your K1 by that time because the partnership decided to extend the return. So there's got to be communications between the partnership and the partners so that everyone knows what their options are. And a lot of, especially, some large partnerships, there's not necessarily a lot of communications between the partners and the entity itself. The entity may be involved in a business and may not even know about the options with respect to qualified opportunity funds, may not even have an interest in it, even if they did know about it. But the K1, the capital gain coming through on the K1 that the partner receives, he needs to know about that in time to be able to reinvest proceeds.
Doug, don't all the accounting firms get you your K1s by like March 15th? And that how it works?
Well, ours does.
Eric, that's how it works?
Yeah. The accounting firm is at the mercy of the client, and October is probably the busiest month of the year for an accounting firm. So let's talk a minute about the incentives for investing. And I said the first is deferral of recognition of eligible gain on your original investment. If I reinvest my gain, that means I do not have to recognize for tax purposes the gain in the year that the sale took place. All right, as long as I reinvest it within that 180-day period in a qualified opportunity fund, I can defer that gain. All right, but that deferral is not forever. That deferral is until the end of 2026, December 31st, 2006. All right, I've deferred it. I now have a taxable transaction on December 31st, 2026. That's when I have to recognize that gain. And again, knowing some of our taxpayers, I can see them, some of our clients, I can see them reinvesting the gain and completely forgetting about the fact that the gain is only being deferred until December 31st, 2026. So if you're going to invest in a qualified opportunity fund, you need to make sure you're putting away or will have, by the end of 2026, the funds to pay the tax for that year. If the interest is disposed of before December end of 2026, that becomes a disposition and the gain is recognized at that point in time. All right, what constitutes a disposition, or I should say inclusion or non-inclusion events? And here's where the accountant is the one that can't get the numbers quite straight. This is, in your program, I think it's slide 17, which comes after 13
Yes, slide 17.
So it's slide 17.
Can you hold for just a second? Do you have a question? Yeah.
I had a question on the deferred gains rate. Is it going to be the rate that would have been paid in the year being deferred, or the current rate?
It'll be the current rate in 2026.
Right. So like an installment sale,
Yep.
you're taking a chance that the rates won't go up.
The rates could go up. No question about it. Okay, so as I said, you're deferring the gain until 2026, but if you sell that or dispose of your interest prior to that point in time, then the gain is triggered at the earlier point. All right, so what are some of the inclusion events that could cause early recognition of deferred gain? And what are some of the non-inclusion events that don't cause early recognition of the gain? Inclusion events, one that you need to be aware of is gifts. If I've reinvested in a qualified opportunity fund and I then gift my interest to someone else, that becomes a disposition and creates a taxable event at that point in time. Distributions from a qualified opportunity fund to investor in excess of basis is also going to be, which would be a deemed sale. That would also trigger at least a portion of that gain. Sale or other disposition of qualified opportunity fund interest, again, are triggering events that would stop the deferral and result in a taxable transaction. One of the issues where we talk about distributions from the fund to investors in an excess of basis, what very often you will find is that a partnership, especially a partnership dealing in real estate, may be able to finance that property, and have excess funds that they may want to distribute to to a partner. All right, debt finance distributions are what they are called. There is some, and normally what happens is that your basis in a partnership interest includes your share of the partnership's liabilities. All right, but with respect to debt finance distributions, normally a distribution within 2 years of property being contributed to a partnership is, the default is that is deemed to be a disguised sale. What the investment in the Qualified Opportunity Fund represents, you're putting cash in, but you have zero basis in that cash, where you cannot contribute property as well as cash, but your basis is deemed to be zero because it represents gain that you have not recognized. And so to the extent that you have a distribution coming out of funds as a result of the partnership, financing the property, the issue becomes, do you have a disguised sale that could trigger part of the gain? The general presumption based on the way that the regs are written right now is that you better wait to 2 years from the time that you make the initial investment before you take out property, even though you have basis in the liability, your share of the liabilities of the partnership, you better wait. Again, what we're talking about are proposed regulations, and Treasury has indicated that this is one of the areas that is still being considered. Examples of non-inclusion events: transfer of an interest to a grantor trust, as long as the transferor is deemed to be the owner of that trust, that would not give rise to a taxable transaction. Transfer by reason of death of the owner of the interest. Transfer of an interest to a partnership in a non-taxable transaction, again, not deemed to be a triggering event, or a corporate Qualified Opportunity Fund. Tax-free mergers or spinoffs would also not necessarily give rise to a taxable transaction. So our first incentive is that we're deferring the gain. Second incentive, partial exclusion of the gain on the original investment. All right, let's again go back to my example: $10 million sale, $5 million of basis. So I've got a $5 million gain that I am now reinvesting in a Qualified Opportunity Fund. Okay, as long as I hold that interest for at least 5 years, at the end of that 5-year period of time, I get a step up in basis equal to 10% of the deferred gain. So I've now invested $5 million into this fund. That's my deferred gain, and so at the end of 10 years, my basis goes from 0 to 10% of the $5 million, or $500,000. All right. If I hold it for 7 years, at the end of 7 years, I get another 5% increase. 5%, so I've got another $250,000 increase, in the basis. So you've got 2 holding periods where you're able to take part of that gain and exclude it because you're increasing your basis, which again starts out at 0. 10% after 5 years, and 7% after, or 5% additional after 7 years. Keeping in mind that the gain is triggered at the end of 2026, and so in order to meet that 7-year holding period, I've got to make the investment by the end of 2019. Hopefully I didn't confuse you on that.
Yeah, and so, Doug, what we'll want to do is maybe move in a minute over to Chris so he can talk about what people are doing on the ground in light of this incentive and the timing element of it. To really maximize the incentive, you're going to have to move pretty much in this year. But why don't you finish up for another minute or so, and we'll get it over to Chris.
Let me hit the third incentive. If you invest in the qualified opportunity zone, okay, you start out with 0 basis. You then, at the end, no later than the end of 2026, you've got a taxable event. Your basis could be stepped up 10%, could be stepped up an additional 5%, depending on the holding period, by a total of 15%. But then any additional appreciation in the qualified opportunity fund itself, to the extent that you hold that investment for at least a 10-year period of time, any future appreciation will never be subject to tax. All right? Now, one qualification on that. You have to dispose of your interest by December 31st, 2047. Now, I probably won't be around at that point in time to remind you of that, but keeping in mind that, that you can defer the gain on that opportunity zone as far as December 31st, 2047. You need to dispose of the interest prior to that.
Okay. We'll probably have to move on in the interest of time.
Yeah. There's an example that if we have time at the end that we can get to, but for right now, let's skip it.
But big takeaway is to really maximize the benefits. You do need to act this year. And so, Chris, tell us all what people are doing as far as on the ground now.
Show of hands, how much of that was familiar to people in the room? Yeah, good. And everybody in the room has some grounding in real estate investing? Some grounding in real estate. Show me a hand, some grounding in real estate investing? Okay, cool. So I'm like the least qualified guy here. I just want everybody to know that. I came at this a little bit different than sort of either of those two vantage points would deliver you into a qualified opportunity fund or even coming at this with a tax perspective. So I'll tell you a tiny bit about why and how, and you'll see probably as I speak or hear as I speak that the key to the castle for what we're trying to do, and it's in Baltimore, so I'm going to tell you stories about Baltimore, is assembling a team of experts. And I've had a history of doing that in the past, so I just tore a page out of that book, realized what I didn't realize, the law piece, Venable's on our squad. The accounting piece, sorry, different team member, Cohen Resnick's on our squad. In each instance, two things were true and a little bit more broad than Baltimore, but it is the case that we're all somewhat blessed here, call it D.C. to Baltimore, to have real experts on the subject matter. And the subject matter is evolving still, as is obvious. It's still evolving. But if for some reason you all are focused in this region, you have access, or maybe are already, experts in a way that the rest of the country isn't yet. So I took a lot of solace in that. My background is in investing in operating companies and a little bit of real estate on the side. I decided two things when this law literally started bubbling up. It looked like it would endure, so probably like everybody in this room, a little bit cynical about what happens in Washington, and didn't know whether a law as determined would be more like a Roth IRA and therefore permanent and codified and gets invested against, or like somebody's passing fancy. So you always sort of have some concern about something that's being motivated by a change in law. I do, anyway, as an investor. This one looked to me to be durable. It's deeply bipartisan. It was stood up with a lot of thought and structure around the whys and wherefores. It was actually launched before the cake was fully baked, and I was okay with that, but one of the reasons we got going in Baltimore fast is me and my partners were okay with that. One of the reasons I think we're here, partway into 2019 with still a lot of capital on the sidelines and not yet deployed through QOZs, is that the law is still literally being refined. So
speaking of that, let me just mention that the law is still being refined. What we're dealing with now are proposed regulations. The regulations first were proposed back in October of last year. Revised proposed regulations came out just last month, and there are still a lot of areas that haven't been addressed, and so Chris is completely right. It is still an evolving process between the issue of the first issuance of the first set of proposed regs and the second set. Members of Congress actually sent a letter fairly extensive letter to Treasury saying, hey, we think you're being too restrictive. We want the regs to be more liberal, more taxpayer-friendly than the initial proposed regs. And I think to a large extent, the latest set of proposed regs are more liberal, and it is still evolving. Chris?
Let me layer on to Chris there and loop him back to Chris, because I think he'll appreciate a piece of commentary here. And that's one of the last things we'll get to is how do you get out of these funds? And the IRS has kind of moved along the spectrum of the first set of regulations was sort of how do you get into the fund. The second set was sort of how do you operate the fund is what we got now. And as Doug just said, those regulations aren't going to get commented on and hearing till summertime. Probably won't get done until the end of the year. We actually get something maybe final. And we've got the tension running through all this that 2019 is when the first of our deadline hits. And if you aren't in by the end of 2019, you lose the first piece of your benefit. And the tension is for people like Chris is you don't know what the exit strategy is to tell people who are trying to come into your fund how you can get out of it. So I throw it back to you, Chris, with that comment.
So here's how we came at it. I decided early that the key to getting money to work over the long term was almost to ignore the tax consequences and find, as ever, a developer with whom you could partner who already had ready-made projects that could essentially be enhanced. So this may get a little deep, but I view the qualified opportunity money as a source of capital, pure and simple. And the way we decided to come at it as a cheap source of capital. So the partnership that we put in place in Baltimore is with a African-American developer named Dave Bramble, who has ready-made projects. We put money to work immediately in one called Yard 56. Baltimore is unique in three ways. One, I said already, proximity and access to true national experts, some of whom I've invited to join the team. The second is an unusually high quantity, sort of a target-rich environment for investing, 42 opportunity zones in a, whatever it is, 6-square-mile city. So there was a lot of places you could think about deploying money. And the last was, and this is most important to me, 2 or 3 developers with whom I'd already interacted in some way, shape, or form who were ready to go. So the rest of it, to me, is settling on the investment merits, which were pretty straightforward. And then, and this goes to philosophy, and I think will inform some part of this conversation at some point. Our view is essentially that this is a double bottom line play. And I came at this with that attitude. I came at this with successes and failures well in advance of the emergence of this law in double bottom line investing. It's full on hard. This actually was a meaningful step forward to both improving the likelihood of attaining returns, whatever those returns were, number one, and de-risking the process of getting the money and getting the money out. So we decided with all of that in mind, our best foot forward in Baltimore probably will be the case for a while, maybe will be the case all the way to the end zone here, is sources of funding like family offices, like high net worth, and like other local investors who have a stake in the community. And because we had this double bottom line philosophy, we also decided that the only thing we were going to hold ourselves accountable beyond and apart from the investment returns was jobs. There's a lot of ways you can metric out the social impact of all this stuff. The stuff that mattered most to us in our community is jobs. And so when we undertake a new project analysis or when we come at a project with ready capital, the first question we're trying to ask and answer is first, how many construction jobs? So let's be clear, we're a real estate investor. We have a MOU with a local VC such that if an operating company were to be stood up within one of our opportunity zones where we're already active, we could become essentially a limited partner in that investment, sidecar. The main thrust of this is building things, and the main thrust of the building is twofold. One is there's a pre-construction construction phase, so again, just using live examples. Yard 56 is a rehab project below Hopkins Bayview, if anyone knows where that is. It's the old Pemco site. So it's basically a brownfield. It's now been completely capped and turned. And that now will be a multi-use project, primarily commercial real estate. Has 500 plus people working on the job right now in construction jobs, and we'll have 300 people permanently through phase one. It has capacity to take another $20 to $30 million of equity in phase two, and we have I wouldn't call it a Congo line, but we've got a small pipeline of related projects in other neighborhoods, all qualified opportunity zones, where we can put money to work straight away. I may be skipping off script here, but there's been some questions about who else is playing. We have seen and tried to work with the local CRA sleeve, so the community reinvestment part of PNC. Terrific guy, Chris Rocky, up in Baltimore, is trying to get stuff done. Would love to do something with it. It hasn't happened yet, so stay tuned on that. We've seen all of the out-of-town money kind of knocking on doors, trying to get stuff done. I would say the long pole in the tent for them is finding Dave Bramble. And by the way, they know the guy. And he's not the only guy doing work in these areas. Another guy named Michael Beatty has developments in opportunity zones. We're working with him. So there's lots of ways to find your way to a project manager. I believe that's where the story will get written. I believe that when
Chris, I'm curious.
Find these guys, they'll have some success.
Yeah, just to that point. So in Baltimore, for example, how many projects would you guess are in place right now?
I don't know. I wish I knew, Brian. But if we go to scale, we'll probably have investments in 5 different projects. By the end of this year, I'd say 3 is plausible. At least a couple of those are going to almost have, because of timelines on real estate projects, are almost going to have to lapse into next year. So they'll be subject to different IRRs.
Okay. And how about in Baltimore in general, the entire city? If you had to speculate, you all.
I extrapolated from the ones that actually know capacity on to the other, call it 40 or 39 zones where we might not get active. I bet you there's $1 billion equity capacity.
Mm-hmm. Oh yeah. I mean, it's almost endless, really.
So in Baltimore, if you pulled a map of opportunity zones, you'd find it includes the entire working waterfront, which is crazy. But that entire working waterfront is an opportunity zone.
Our office is located in an opportunity zone in Baltimore.
It's double crazy.
Yeah.
So we're kind of the opposite in a lot of ways. We're working in truly disinvested neighborhoods. I would say the most improved neighborhood we're working on is actually the one at the foot of Hopkins Bayview, and that's a transition neighborhood. The next one is just south of Morgan State, relatively stable working class neighborhood, but needs a lot of help. And then the last one is just north of North Avenue. If you ever heard of a guy named Freddie Gray, it's literally within blocks of where he lost his life. So these are true community-oriented projects, again, led by a local developer who's got chops and experience. And I feel very confident we're going to actually get our money back, irrespective of the end date on the tax rate, at some number that, if you need it for sort of marking the future, is a double-digit return. I don't know how much higher than 11 or 12 it will be, but I think that's the thing you think. And when I look at these lists that come out of other people that are playing or building big pooled products, God bless them all, but some of them are processing something like a 15 or 16 or 17 or an 18% IRR. I'd push them on that. I'd push hard on that. I don't believe that will be the case. These projects take a long time to stabilize, a long time to occupy, and a long time to produce income. And I actually think 10 years is maybe not enough, but we're oriented that way because that's the structure into which we put the capital. And again, we're kind of crass in this one way, which is, for us, this is a way to get money to work in neighborhoods that need it cheaply. So our view on IRRs might be different than maybe a retail investor. We have I don't know what that is, but we have a slightly different perspective on how that all works, and feel quite satisfied at the numbers we're seeing from the analysis. And full disclosure, no one knows. We probably know more than most people, and we've got kind of an early look at money we actually put to work last year and this year. Looks good, but it's early days. So I think part of this conversation with all of your clients and associates ought to be conservative in your assessment of the returns. Try and find things that really seem like they're going to work for the right reasons, And if for some reason this odd way of thinking about it that I'm coming at you with, this sort of double bottom line approach appeals, well, then I think this is an amazing enabler. Then I actually think this law is an incredible enabler, and I think it will pull a lot of money off the sidelines. And it has. The simple button on that, we haven't said it yet, the simple button on that is selling appreciated stock and putting it into a qualified opportunity. So we're really simple people. So that's what we're trying to do. We're trying to find people with appreciated stock, private or public, that want to lock in the gain, go for an investment in a community that they care about, and then be at the table with us to both watch it grow and develop and help us think through this jobs thing, because that's the piece that actually is going to require a lot of thought in year 2, in year 3, and year 4.
So, Chris, so someone like yourself comes to one of the other folks on this panel or some of the other folks in the audience, and time comes to figure out how to structure yourself in order to move forward. I'm going to turn it to Walter to talk about what you tell someone like Chris who comes to you and says, hey, this is what I want to do. How do I get started?
Chris, can you wait a couple years and come back and I'll tell you what the rules are? Fortunately, there's a lot of truth in that. So these proposed regs just came out, as I said, about a month ago, and there are about 10 or 12 sort of hot topics come out of those, and I think we've hit on 2 of them so far. So on the structure topic, I'm going to try to move through it quickly so we can, at the back end, pick up stuff that just doesn't flow in the natural course of things and deal with questions you've got. Don't hesitate to jump in with questions along the way, but I'm going to try to move quickly with the thought that many of you know what I'm going to cover here, and some of the detail is not as of interest. But again, slow me down or question me as I go. See, I'm really jumping fast here. No, but so Doug talked about sort of the investor side of this. Why does somebody want to put money into a fund to begin with? What drives this program? We're going to move on now to the sort of the fund side of it. What is a fund, and what does a fund need to do with its capital gains that people have dropped into it? And I'm going to mainly focus on why this slide doesn't work and why we don't see this slide in practice. We spent our time so far talking about the circle at the upper right, investor. We're now going to spend our time focused on the triangle, which is the Qualified Opportunity Fund, or QOF as some are now calling it. And so you've got your $100 of gain as an investor. You hand it over to the triangle, the fund, and well, what does the fund have to do with it? Well, this is sort of the simple model in which the fund is taking that cash it's got and putting it directly into a business activity in the zone, the square box at the bottom. And this is what I like to call the silo approach. It's just kind of an up-down. The investor drops its money into the fund, and the fund drops its money directly into the project. We're seeing virtually nobody use this structure, in brief, because the timing by which the fund has to do something is very fast, or it starts getting hit with penalties. And I'll get a little bit into that, but not too deep in just a second. So the typical structure is really this one, where the bluish box at the upper right, investor takes its $100 of gain, drops it into the triangle, the fund, and then the fund is fairly promptly going to take at least $90 of that $100 and drop it on down into the blue box, which is another legal entity, either a partnership or corporation. And that's going to be where the actual project level or startup business is going to be taking place in the zone, is in the blue box. And this is all driven, again, by rules that are, you question why they're there and why they work, but they're the ones we're forced to deal with it. The fund gets hit as soon as it gets a contribution in. It gets hit with testing at each 6-month interval thereafter. That it hasn't deployed at least 90% of the cash it's got into a business operation, buying real estate or dropping it into the blue box, a penalty starts to accrue, essentially about a 5% penalty for the amount that's not deployed. Let me go back, find our 90% test here. Here we go. So to run this through you real quickly, if I've got my $100 of cash and I drop it into the fund, within 6 months, and this is one of the other hot topics, is the IRS just gave us a 6-month grace period. You get to dodge the first 6 months. They've given us a little flexibility on what the fund can do, but it's not going to change much. We're still going to end up with this 2-tier structure. But just real quick example why the penalty is problematic is I drop my $100 into the fund. The fund is able to pretty quickly deploy 85 of those dollars. But then it starts getting hit with this 90% test, which says, have you deployed 90% of the $100? I've only deployed 85 of the dollars. I'm $5 short. That $5 is going to get measured at each 6-month interval, and to the extent it isn't deployed, that $5 shortage gets hit with the 5% penalty, or $2.50 on my $100 of invested capital is going out the door and having accomplished nothing. So that's really what's driving one into, I lost it. There we go. The 2-tier structure. And then what adds to this, and this is sort of more the real world, is what I call more the hourglass structure, which is, Chris has described the mode he's in, which is sort of the in-between structure where you're, it's the most easier to do with the rules we've got. So even there you're challenged, but where you've got, and that's not this, let me go back. You've got a developer who's identified the box at the bottom. He's got his real estate development project ready to go in the opportunity zone in bad area in old Baltimore City somewhere. And there's a capital gain investor up top ready to put money in. And so you got a small group of investors with targeted projects. This sort of more or less up and down silo model works. You're going to drop it down to a lower tier entity that's actually going to do the business. This is what you're going to read about on the internet or get your prospectus on is and this is what, as a family office, you may be trying to choose between these models. Do I go and do my own real estate project and focus on it? Or I'm doing a specific one project or 2 projects with my family office money? Or do I go find one of these syndicated projects where I'm bundled up in the upper right circle with a whole batch of investors popping $200 million into a fund, which is then going to do multiple boxes down below. It's going to sprinkle its money among 3, 4, how many different portfolio companies, maybe 100 portfolio companies, and then they're going to be off doing different projects.
Yeah, well, and that's worth emphasizing as a point here is that Walter and I, we could go out this afternoon and start our own fund with just our own money. And we can go ahead and invest in OZs and defer gains as much as we're able to. We can do that, or we can go ahead and put our money in some type of a major fund that's got investors from all over the globe. We've got everything in between, and we've got those 2 extremes to choose from. So there's all kinds of different ways to get into these funds.
Yeah, I'll add just a little of that and then turn it over to Liz to actually talk about those ovals down at the bottom, the portfolio companies. But as Brian was saying, just a briefest commentary on what a fund is. It really is one of the simpler creatures, but messier creatures the IRS has given it. It's got to be a partnership or corporation under state law. Does mean either of us, we could go out, as you said, and set up our own LLC. It doesn't become a fund until we file our first tax return at the end of the year, and on it include this IRS form that designates that the entity is choosing to sort of retroactively be a fund. So there's a lot of games to be played with funds up front. If you find you're not going to qualify, you can sort of go the route Chris was talking about and decide, I'm not going to play the fund game. It's not worth it. I'm going to just have a traditional real estate investment and live off whatever that would be. When you hit next April, you're filing the form and deciding you're a fund. You can use corporations as funds. We're not seeing hardly any activity, I think, with corporations other than that funds can be real estate investment trusts. And so a fund can be set up as a corporation and real estate investment trust. You can use a S corporation, but we're not seeing much of that. Maybe I'll sign off there and can come back to some of these topics, but I think that's an overview on sort of what the fund is. And Liz, leave it to you to...
Yeah, Liz, go ahead and tell us about the projects. Tell us the other things we need to know.
Sure. Do you mind passing me this?
Yes.
Thank you. Okay, so Walter mentioned this 90% test that applies at the fund level. So 90% of your fund assets need to be one of these three types of things: qualified opportunity zone stock, qualified opportunity zone partnership interest, or qualified opportunity zone business property. And for some reasons we'll discuss in a second, and as Walter mentioned, to satisfy this 90% test, most of the time your fund is going to own 1 and 2, so stock or partnership interest in an actual operating business, as opposed to directly owning the property itself. So I will skip through these. But they just talk about how you have to acquire stock or partnership interest after a certain date in order for them to qualify. The more interesting topic is what is a qualified opportunity zone business. So that's going to be your operating business, or the blue box on our prior chart. So to be a qualified opportunity zone business, the entity needs to own or lease substantially all of its tangible property in the opportunity zone. Here, substantially all means 70%. We'll say substantially all other times where it doesn't always mean 70%. So here it means 70%. So important thing to know. The business has to generate at least 50% of its total gross income from the active conduct of a trade or business in the zone. And there are certain safe harbors for that we just got out of the new proposed regulations. It needs to use a substantial portion of its intangible property in the active conduct of a business in the zone. And again, here we use substantial again, but this time it's 40%. And the business can't have more than 5% cash assets, except to the extent that the cash is a working capital, is used for working capital. And there's also a safe harbor for working capital, which we'll talk about. And then the opportunity zone business can't be an ineligible business. So ineligible businesses, or SIN businesses as they are sometimes called, golf courses, country clubs, massage parlors, hot tub facilities, suntan facilities, racetracks and gambling, and liquor stores. So none of those would qualify as a qualified opportunity zone business, even if they're in the zone. So qualified opportunity zone business property. So we know that the operating entity has to have substantially all, 70% of its assets have to be qualified opportunity zone business property. So that's why we do this two-tier structure. So you have a 90% test. 90% is satisfied by your interest in your stock and your partnership interest. And then your actual operating partnership or corporation only has to have 70% of qualified opportunity zone business property. So if you got rid of that middle layer, your fund would have to have 90% that qualifies. Now you really only have to have 70% that qualifies. And once you qualify as a business, your whole 100% value of your business qualifies.
Yeah, Liz, and it good too that you can leave 10% at the upper tier and then 70% at the lower tier. So it's actually even more than 30%, right?
Exactly. So there's the 90% test that applies at the top. So you can have 10% of your cash there, and then your 70% at the second level. So you could have up to 30% cash there.
So that's 40%, right?
Mm-hmm.
Yeah, I mean, you hear that. I mean, you know, when this all started, you heard this 63% number. Gee, it's only 90% you got to strip down and 70%, but in practice it doesn't really work because you just don't want to leave the 10% cash up there hanging out. And there's also a rule that there's a rule that you can't have more than 5% of your funds held in cash. It's a real driver of a lot of the discussion. We'll get to that, but it's very awkward to have cash sitting that's not satisfying one of our safe harbors. Well, I'll turn it back to Liz.
That's nice. So your business property is going to be not cash, but tangible property that's used in a qualified trade or business. If the property was purchased by the fund from an unrelated party after December 31st, 2017, the original use of the property in the zone starts with the fund, or the fund substantially improves the property, and during substantially all of the fund's holding period, here substantially all means 90%, substantially all of the use of the property was in an opportunity zone. So we'll go through each one of these. One thing I guess I would just note is that on the second point, the property is purchased from an unrelated party. So going back to Doug's point earlier, for our purposes here, the related party rules are reduced to 20%. So when you're dealing with entities that have some overlapping ownership, it's really easy to run afoul of these rules. So you can't, if you already own a property, you can't just set up a new entity and sell it to yourself. You would be stuck in these related party rules. There are some workarounds for this, but because the threshold is so low, it's hard. It's a lot harder than if it was a 50% threshold like it usually is.
And Liz, this is worth pausing there because this sends you over to code sections 267 and 707 where you get related party rules. And the one thing I heard early, and we're finding, Liz, you dealt with me on this, is the one area where there's kind of the most play we've seen in those rules is using trusts. The rules don't tend to pick up trusts as much, so that if you're able to bring certain trusts into your play and you're trying to break these related party rules, that's an avenue to keep in mind is trusts.
Okay, so we have our different requirements. We have to have tangible property that's used in our trade or business, acquired from an unrelated party after 2017. We have to have an original use or substantial improvement requirement that's satisfied, and we have to use it in a zone. So in real estate, obviously, it's going to be easy to use it in a zone, but there might be some more questions when you're talking about an operating business. So when we talk about substantial improvement, there's a special rule for how you substantially improve a property, and generally you have to put in your purchase price of the property as your substantial improvement. So if you buy a building for $1 million, you need to put in at least $1 million of improvements to it in order to qualify. When you're figuring out like how much of the million do you actually have to put in, you can exclude your land. So here we have an example. The fund buys property for $100,000 and 25% of that is attributable to the land. You don't actually have to put in another $100,000. You only have to put in the 75 that's attributable to the building. So a little bit of a interesting facet there. So as Walter mentioned, one of the big issues is the fact that you can't have all this cash hanging out, or if you have more than 10% at the fund level, there's going to be a problem with qualifying your fund. If you have more than 30% at your operating business entity level, there's going to be an issue qualifying your business. So the good news is you can't have more than 30% cash, and it's two rules that are kind of tied together. One is that you can't have more than 5% non-qualified financial property, and then there's also the 30% rule as well. So the 5% rule is that you can't have more than 5% of your assets that are cash other than working capital. So they have a working capital safe harbor that only applies to qualified opportunity zone businesses, which we will talk about. So you have more than 5% cash if you qualify for one of these working capital safe harbors. So you have to have a reasonable amount of working capital, and that exists if you have a written plan that identifies the cash as property held for the acquisition, construction, or substantial improvement of tangible property in the opportunity zone. And now under the new proposed regs, you can also have a plan that identifies how you're going to use the cash in an operating business as well. You have to have a written schedule that shows how the cash will be used within 31 months, and you have to actually use this cash in accordance with the plan. There is an exception under the new proposed regulations that says if you can't actually get your cash out within 31 months because there are government delays especially with regards to real estate projects, there's an exception for that and you're still okay. And as money comes in, you can start a new plan. So if you start your fund, you get a bunch of investments, you drop it down into your business, your 31-month period starts, and 6 months later you draw down more capital, you can start another 31-month period from that second 6 months. So as I mentioned, the working capital safe harbor is now also available for startups and other operating businesses. So we know if we have real estate to be qualified opportunity zone business property, we have to satisfy this original use or substantial improvement prong of the test. So the question is, what if you don't actually have property and you're just an operating business? How do you qualify? So for an operating business, you have sufficient gross income to qualify as a qualified opportunity zone business if one of these three tests are met. 50% of your employees are independent contractors, work in the zone based on their hours. Based on your payroll, 50% of your employees or independent contractors are in the zone, or your business and management or operational functions that are in the zone are necessary to generate at least 50% of your business's gross income. So one of the things that came out in the proposed regulations that were recently released, which is probably a function of trying to make the regulations more taxpayer friendly, are these very favorable rules about leasing. So we've run into a lot of problems where we have someone who has already purchased property that is located in a zone and they want to get the benefits of this, but they can't because they already own it and it has not been acquired by purchase after 2017. So one thing that you can potentially do is lease it to an entity, and you can actually lease to a related party. So even though you couldn't sell it straightly to a related party and qualify the property, you can keep holding the property and lease it to a related party, and you can qualify if certain things are met. The lessee can't prepay for more than 12 months of the use, and then for tangible personal property, the tenant has to spend an amount in the zone that's equal to the lease value. But for real property, this rule doesn't apply. So this can be really favorable if you have a property that's already in a zone that you want to use.
It's worth pausing on this because this is one of the most frequent topics we deal with, and it gets a little quirky when you actually try to play it out. It's one of those things the IRS gives you and it sounds great, and then like many of the things they're giving us, you kind of, after you work at it, you kind of aren't quite sure what it gave you. So take this situation that often comes up. Developer already owns the property in the zone and wants to plop it over into a fund. Well, the rule for acquiring it by purchase, as Liz described, doesn't really work because it's a related party. But leasing, no problem. So you could lease it over. You then get the question of, well, what is it that then is going into your tests? And yeah, why don't you talk about that, and then we'll come back.
Sure. So now you have this leased property that's in your blue box, and you're trying to figure out, well, what do I satisfy the test for my blue box to be a qualified opportunity zone business? And you do actually get to count the value of the lease as good property for purposes of figuring out whether you meet the 70% test. And the value of the lease is based on your financial reporting or the present value of the lease payments. And the great thing is for the tenant is that they don't have to have the original use or substantial improvement requirement satisfied, subject to the caveat that if it's a lease of tangible personal property to a related person, you do kind of have a similar substantial improvement requirement. There is an anti-abuse rule that says there's no plan or intention or expectation that the lessee will ultimately purchase the property for less than fair market value at the time the lease is entered into.
So, because it gets back to what Walter had raised, because I've gotten this question easily a dozen times. Client calls me and says, I already own property that's in a zone. Isn't that great? And before the most recent batch of proposed regulations, it wasn't as great as the client expected because of the limitations that applied. But now there's more flexibility as to what can be done because there can be.
Do you think it's great?
Well, there's a potential to do a lease of some kind, correct?
There is?
Yeah.
But then where does it get you?
Well, that's where I was going to lead you. So walk that client through what they can do under that fact pattern. They have, let's say I've got one client who had undeveloped land in Virginia, and they were all excited about it being in a zone, but didn't quite know what to do with it. Now, what can they do? Now, obviously, they can sell that property, and that's probably worth quite a bit more because it's in a zone than it would have been before it had been in a zone. But what can they do with a lease structure?
Yeah, and we should play that out because we've somehow jumped to the leasing topic beyond what, before we had this leasing option, was the way we tended to talk about this, was the related party rules would typically have you, developer owns the land, there's the fund somebody's going to put their money into over here to enable the developer to build up the improvements on the old land, and how do you get the land over here? Well, the old way of discussion was related party rules say that the developer can't have more than a 20% interest in the fund. And so Chris is quite familiar with this structure of trying to keep the developer's interest in the fund below 20% so the developer is not a related party. And most of the time the developer doesn't want to be below 20%. So that's a structure that has been worked with, but the leasing opens a new approach, but then you got to figure out where it goes. Is okay, developer leases the property over, and the discounted present value of the rental stream pops out a number, or the accountants on the audited financial statements come up with a number that creates a value that helps you satisfy your tests, because it's suddenly what would have been a bad asset if it was from a related party becomes a good asset despite being from a related party and goes positively on your balance sheet. Okay, so that's fine. Fund now has the land. Fund goes off and spends umpteen $1 million improving the land. 10 years pass, you're ready to sell off. Well, what's it going to sell off? It's got a leasehold interest in property. A lot of the value lingers over here, where you got to sort out, where is the value? And that's sort of the challenge here is you don't have the fee interest in the property like if you bought it, so that all of the rights aren't over here. And, the easy answer is, well, 10 years out, you get the developer to join with the opportunity zone and all the interest gets sold at one time, the landlord's interest and the tenant's interest with the improvements on them, or you get the lease terms somehow to work in a way that there's still a lot of value in the ground lease with the improvements on it when you sell out of it. But you somehow have to deal with the fact that you don't have all the interest in the thing that's been built in one place once you go to the lease structure. So it's great the IRS gave us this, but as soon as they gave it to us, we end up trying to solve the next problem, which how do you deal with sort of the
And if you went with an extra long-term lease, that might work, but there's a point after which a long-term lease can become a sale. I'm not sure any of us know exactly where that point is, but 99 years tends to be a sale as opposed to a lease most of the time. But good point. Good point.
So, more in here.
All right. Well, fantastic. Well, I'm going to turn it back over to Chris to talk a little bit more about how the people on the ground are reacting to these structures, and are they seeing them as too limiting? Are they working with them? What's your thinking there, Chris?
I don't think anybody has seen them as too limiting. I guess in large measure, because you all have done the heavy lift on that. I want to get super clear on it. We've got an investor base that's looking at the Oasis Fund, which is our vehicle, as two different things. And one, I guess one view of it is we've organized the team to discharge all of the expert advice and to keep people free and clear of whatever is going to be coming their way legally, from an accounting standpoint, and really from an investing standpoint. So conceptually, Oasis it's a fund. It's like a fund management company. It's really what it is. The second thing, which is a little different for us versus the aggregators, and I should go back and talk about who else is doing this and kind of a little bit what the national picture is starting to look like. The second is we're pretty specific to neighborhoods we know well. I've talked about Baltimore. We can extend to Philly. We've got a few projects we could activate in New Jersey and Boston. Conversely, what Oasis isn't and won't be to the investor group that we're working with is a national footprint endeavor. I mean, I'll just tell you in this room, I'm doing this on the side. This is not my full-time job, and thank God it's not, because we're still trying to figure it all out. But it is a passion project. I've got a lot of time and energy for it. I've found the right kind of partners to work with. So to be fair and frank, I'm not working that hard on anything other than finding the money part and then making sense of what's being told to me by sort of this expert panel. Away from our effort, I would say identified capital about to deploy or getting deployed seems like it's about a $20 billion number right now. I've seen a bunch of different lists. You all have probably seen them. The biggest pools I've seen nationally are around $3 or $5 billion, and the smallest go all the way down to 50 or 75. Most of those are kind of an aggregation model in the one regard. We'll take your money, we'll go invest it. So kind of like a mutual fund of opportunity zones. And in another regard, truly national scope. So again, we see them around some of the projects we're looking at. We're keen to have more money invested in these neighborhoods, again, because we just keep on coming back to this double bottom line mentality, so more the merrier in that regard. There's a little bit of a compulsion to act, I think, for everyone in this room, and for us certainly, in as much as this money lands, it does run prices. So there will be, we believe, some crowding out or crowding in effect, and it's all good. It's good for the neighborhoods, but that will temper investment returns. I'm going to beat that drum one more time. That's another reason that we kind of launched the endeavor with a conservative mindset about what will come back out the other side. The yield enhancement piece alone, everything that's just got talked about today, is around 300 basis points, around 3 percentage points on top of whatever your organic returns would have been. So that's how people dream big dreams about what the returns might be. But I think of it, there's about 3 points of play, extra yield, if you will, in these returns baked into all these rules. And again, how you deliver returns to your investors is a little bit determined by what your philosophy is. Again, ours is to get the money to work first and foremost. And secondly, to use, if you will, some of that elbow room to actually lower the capital cost to the developer to activate the project faster. And if you want to get really technical, probably have a higher equity return at the end. That's the way we've thought. The corporate finance piece of this is all that. Who else is playing? Banks are playing. I mentioned PNC. We're partnered with Pru, so you all will see in each and every one of these projects that you kind of go forth and hopefully prosper with. Very active interest from, it's generally the alt investment side of large existing insurance real estate arms. So Prudential is alongside us, alongside Oasis. In our first project, I fully anticipate they will be alongside us in our second project. They're very committed to the endeavor. And they have, in my appraisal, as does certain portions of bank-committed capital, the right construct. So they're coming at this like community redevelopment. they're looking for enhanced returns. They're oftentimes contributing almost idle assets. So they're, the pot that they're kind of dipping into oftentimes is repossessed homes or whatever. So they've got kind of capital sitting inside their account, literally in their treasury section, that they're using to activate in this way. So they're compelled to act, and I think all of that money will keep these folks busy. I would anticipate a very busy second half of this year, because that money will be a lot more laser focused on this twofold step up. By getting money to work by the end of this year, you get the full 15%, and that, in our opinion, will crystallize a lot of decisions which are still kind of in the conversation mode.
I'm curious. We talked about this before. To what extent do you think that amounts that had been historically earmarked for charities will move to these types of investments?
Yeah, I don't know. It's an interesting. As soon as I said it to you, Brian, I started to reverse my thinking on it. So inside family office is a good way to think about this kind of constructively. Family offices are already generally oriented toward this kind of thing. Family offices already heard a fair amount about it because they're well advised by folks like Venable and the E. Cohen folks. So they're most likely to be actors, and they already are. So we've got, I can't talk by names, but I can tell you that's, part of our capital base is family offices. The thing I was talking about with Brian is it's a little bit of a market share shift, if you will. So if the pot of capital didn't grow at family office XYZ, then this would be a new commitment, and they'd have to find another place to either de-emphasize or reallocate from. So that's one kind of almost like portfolio management way to think of it. I will say, this is where I started rethinking myself a little bit, Brian. I will say, because of this taking a large taxable gain off the table and committing it directly into the community, it does feel, and again, it's early days, but it does look like it almost produces an incremental source of capital. So if a family office has a foundation, the foundation is doing a lot of community investment. Okay, well, that's a pot of capital almost being run like an endowment. And so they're running off of, kind of a spend fee, a 5% kind of blah, 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 blah. And occasionally they'll dip into principal and do something really splashy. Got it. Okay. Well, this is a little different because a lot of family offices are stood up with large taxable gains in a private or public enterprise. And this does feel like a moment in time where you can take some money out of one of those and put it directly to work in your community. And again, that's what we've seen. So it
does. It's interesting, too, how the activity might be tied to the performance of the markets as well.
Yeah. I keep beating that drum.
Right.
So, and we, again, without naming names, wouldn't do it. But it is the case that as stocks run up, just using stocks, as stocks run up, people get super engaged and tend to wind up, in this small instance, being more active funders. And so I think people are beginning to use it as a tool in that regard. Mm-hmm. And I think they should. I'm encouraging it.
Sure. And it's fantastic the way that the lack of tracing rules work, and they make that so easy to do.
Yeah.
I got my gain today in May.
Yeah.
I've got a lot of time to figure out to deploy it in a zone if I'd like to do that.
Yeah. And again, I think keeping it simple, Brian, I think we're blessed and lucky because we got guys, plural, but one guy in particular, who's ready to fund now. Mm-hmm. So we're not going to. So another approach to this would be to aggregate a bunch of money and make some money on the money. We're kind of classic mutual fund. We're kind of not in that business. We're in another business. We're in the business of getting money to work, and therefore we spent more time, me first, but now us collectively have spent more time trying to identify those projects that are ready to fund, and they go right to the top of the stack, and then we build the pipeline out with those projects that will be ready to fund and figure out what the timing of that might be.
Makes sense. I know that we're getting a lot of questions on these types of issues almost every day. I would expect that the accounting firms as well are getting those. It's really an everyday kind of thing. Yeah. It is something probably more so than any other new development in all my years in practice. This is getting more discussion than I can recall anything else getting.
Timing becomes very critical, especially when you consider the 180-day period. By the end of 2019 to get the double step up.
Sure. Sure enough. So it should be a very busy second half of the year.
I
Yes,
want
sir.
to make sure you keep time for the elephant in the room we need to get back to here in a minute. Go ahead, let's deal with questions.
The elephant in the room being?
We haven't gotten to it yet.
Okay. Well, we'll take this question first.
Idea out there to extend past 2019/2020 deadline?
That's a good question. I meant to mention that when Doug, there's one of the, so there is a program called the New Market Tax Credit Program, which sort of has the same theme to it of promoting investment in low-income communities. And it has with it a whole batch of reporting requirements that try to find that there was community benefit resulting from the investments that are made in low-income communities. This program has come with none of that and has received a lot of objections because it hasn't. That has had caused the sponsors to now go back to Congress and propose including reporting requirements to show the community benefit that results from that program. My understanding is that the bill, which is now going to move that forward, includes a proposal to defer by 1 year the first 10% step-up rule from 2019 to 2020 to kick things back a year. I'm not understanding there's a lot of traction for that piece of the bill yet, but that is the piece of legislation I've heard about as a 1-year move back.
So it might become another one of the extenders that every year comes up for discussion? Could possibly be. What is the elephant? Oh, another question? Yes.
Well, I should say, no, I don't think so.
No, there's,
No, they don't have to be, they
Yeah.
don't have to reside. Yeah, they don't have to live in the zone.
Question. So then you get to how you're going to manage the project, and a little bit of his finger crossed. Right? That you can't really control. You can't really control who finally passes. You can control for two where you put in the project. And you can begin, if you would like, to create, and this is having application process that favors city residents. Having city residents that are policemen get a bonus. You can do things like construct policy so as to orient toward those. We're really early in the session, but we sure.
yeah, so
Just like a lot of things, it comes down to kind of commitment of the entrepreneurs, commitment.
So one of the tests Liz went down her list with is that to have a good business, a qualified operator's business, at least 50% of the income has to be generated from in the zone. And this is probably as close as we get to your topic there, is that there's 3 different safe harbors as to whether how you figure out how income is generated in the zone. And 2 of those are based on are you, by hours or by payroll, how much of your employee base is working in the zone. But again, none of that requires residency in the zone, but it does require people working in the zone.
Yeah, so in theory, you set up the zone and you bring in people from the suburbs to do the work. Is that's what, I mean, that's hypothetically something that could happen. But in theory, that would still benefit the zone, even if that's what happened. Not all the employees would be like that. Mm-hmm. Yes, sir.
Would the purchase of a vacant building qualify as an original use?
Go ahead, Doug.
Property that has been vacant for, I think it's a 5-year period of time, and you come in and rehab that can qualify as original use. It's got to be vacant for a 5-year period.
I mean, that's a great question, too, because, Chris, you may know this, the number of vacant homes in Baltimore City. I mean, I've heard stunning numbers.
I don't
It's in the hundreds of thousands.
Yeah, I don't have the number, but that is
Yeah.
in the right neighborhood.
So that's a very good question. Yes, sir.
I just have a question about the 10-year holding period. You noted that death of the owner is a non-inclusion event. Does the holding period of a decedent tack on to the holding period of a beneficiary? So if a decedent held it for 3 years not an inclusion event, is the beneficiary only now hold it for 7 years, or does it reset the 10-year clock?
In the case of a death, the holding period of the decedent is tacked on.
Okay.
Yeah. And then it becomes, and it, Doug, and it right, it becomes income in respect of the decedent to the beneficiary?
Yes.
Right.
Thank you.
Did you want to talk about the elephant in the room?
Yeah. So on one of these panels I was on, there was an investment manager from one of the big investment banks in New York who serves to advise family offices and individual investors, and she has no stake in the game. So her analysis was strictly, should somebody invest in one of these funds or not? And her bright line test was sort of, can you tell me that the rules, the tax law rules we have today, will get me the benefits you're promising? And that's the way she was going with her family offices. So where I would take you is if you in fact pick up one of these prospectuses, or your clients or you are looking to talk with a particular developer and he's got a fund he's setting up, the question I would focus on, where I'd flip to in the prospectus, is what's the exit strategy? How do you get out of this? What's the promise that 10 years down the road there's a means for me to actually sell out of this thing and get my benefit? Because the rules we got first that have been liberalized a little bit was the only way to get out was to sell your interest in the fund. So, and if you go to page 48 in your handout, this exit strategy piece is there. I'm leaving the diagram up. Why don't you leave the diagram up just so you can see where people are. So this is saying if you're in the investor in the upper blue circle, originally the only way out was to sell your interest in the triangle. Well, the triangle may not be a publicly traded, and probably isn't a publicly traded creature. It has no liquid market to get out of it. And there you are 10 years down the road wanting to realize the wonderful benefits of selling off your now highly appreciated, well-done project, but you have no market to sell out of it. You're stuck there. What the IRS just gave us was the ability for the fund to sell its assets. So that now means the fund could sell off in what's going to be virtually all the structures, its interest in the blue box, the partnership or corporation that is invested in. And again, there are probably going to be liquidity problems with the fund in a timely fashion being able to sell off that entity. The program really, what the IRS gave us really envisions that the fund is going to be operating the business. It's going to own the real estate and sell the real estate off, and then has a rule that says, well, if it does that, if it actually owns the assets and sells them off, it's only the capital gain assets you actually get the benefit of, which means if there's anything else in there, you're losing some of your benefit. Right now, there's no benefit that says, okay, developers put this nice double-tier structure in place, has built the real estate down at the bottom in the square, owns it in the entity in the blue square, and blue square is now ready to sell out the land because the wonderful people who are going to be the best price for it don't want to buy an entity, don't want to have whatever comes with buying an entity. They want to buy the land and the building. Well, that doesn't work. That's not an exit strategy. All that gain is going to flow through the two pass-through entities up the channel and just be gain. And doesn't permit a readily available exit strategy. We're still hoping the IRS may give us something more, and I'm sure people are going to think more about how to make this work, but the whole exit strategy is kind of out there a little bit. Some of the big funds, just so you hear it and are aware of it, are in a strategy where their plan is to take the blue box or convert, somewhere in the process, convert to a REIT, and then have the REIT become a publicly traded entity so that they can, in fact, have their investors sell out of a publicly traded entity and provide an exit strategy. And there are a few more being floated around like that, but that's where I would take you if you're on the investment side of this. Think about, okay, what's the exit strategy, and or am I willing to live with the risk that I've got to wait to find out what the exit strategy is someday in the future? Yeah,
In any event, the ability to exit independently is likely to be severely limited, even in the best of circumstances. I mean, I would think that the problem that you just described will get fixed because it's such an obvious issue to fix. But if I'm in a fund and I'm the only one that wants to exit, I'm in a bit of a box. Yeah. Okay, I think we're done here, but we've got more time for questions if there's any others that you folks would like to raise. Yes, sir. Do a reverse opportunity zone investment.
Yes, if you're in a partnership. If your asset you're selling is in a partnership.
And that works. If the partnership sells it, that certainly works, because then you've got 180 days from the end of the year to do it. Now, what if you had a 12/31?
That is the challenge when you hear a lot of these rules, is it works, a lot of thinking goes the other way of how long can I defer my having to roll the gain I've already got in. The front end where you are doesn't immediately meet these rules.
You don't have the gain yet, and so the question is, can you go on and invest and then?
Right. I can't target for the later.
Yeah. It's tough. The statute's pretty clear. It does talk about how you're able to exclude gain as long as you invest within the 180-day period beginning with the date of the sale or exchange. So it would seem to preclude what you're looking for, which is the ability to do it in reverse order.
I will mention this. I haven't fully thought through, and this was part of the new rules we just got, that prior to last month, the only way to acquire an interest in the fund was to hand your cash over to the fund. Blue box or blue oval, hand your money to the triangle. What the new rules gave us was that investor in the blue box need not be a qualified investor. It can just be me. I may have taken my $10 million and plopped it in there and have set up a fund, and you could come in later and buy the interest from me, you being a qualified investor. And there may be some play that comes into being in what you're talking about in trying to strategize on the timing, that the fund exists, there's money already in the fund, it's some other source of money. Maybe I'm your best friend and I've gone to the bank and borrowed $10 million to help you out and got the fund set up. Haven't yet got the property, but you've got the property. And I'm not putting this together real well, but I guess I'd buy the property into the fund and then you'd buy the fund from me some point. But there may be some strategies that get you there along that line of thinking that the fund pre-exists and somebody else got their money in there and you're buying from them. So.
The other thing to keep in mind is originally it was thought that you could only reinvest cash. Now you can reinvest cash or property. So again, you've got some flexibility in there. I didn't hear you. The issue of no, you can't buy the asset before you recognize the gain. That doesn't work.
Maybe through forward contracts or options or leases or these types of things. In a lot of ways, you can draw some parallels to what goes on in 1031 when it comes to trying to get to these timing issues. There's often, with a collaborative party on the other side of a transaction, a way to move a sale or exchange date. Any others? Okay, well.